afternoon to everyone, and thanks for coming to today's webinar, Building Value in Market-Ready Businesses. Our guest speaker today is Donna Smith, a chartered accountant, chartered business evaluator, and certified financial forensic professional with over 25 years of experience advising First Nation organizations, for-profit business, and not-for-profit organizations. Donna has built a strong reputation for preparing detailed business valuations, feasibility studies, and strategic financial reports. Her insights are have guided countless clients through major financial decisions, whether it's acquiring a new business venture, securing funds, or planning a strategic business exit. Today, Donna will share her experiences on succession planning strategies to maximize business value and how to prepare a business for sale, with all the focus on helping business owners get the most from their hard-earned investments. We're very fortunate to have her today. And with that, Donna, I'll allow you to take it from here.
Perfect. Thanks so much, Peter. I appreciate the opportunity. And I wanted to first acknowledge that we're gathered on the traditional territory of Fort William First Nation. We respectfully recognize and honor their enduring connection to the land, their rich cultural heritage, and their ongoing contributions. We're really thankful today for the opportunity to be here and commit to fostering respectful relationships with all Indigenous communities and peoples. Today, what I'd like to do is, I'm going to actually give you a lot of information today. We're going to touch on a lot of different pieces as it relates to selling your business. Selling your business isn't necessarily like selling, a product every single day. Selling your business has lots of different components to it that we want to really think about and get you to start thinking about as you potentially plan for your potential sale of your business. Today, we're going to focus in on the importance of succession planning, ways to maximize your business value, and business selling strategies. When we walk through why succession planning is important, we want to really focus in on what succession planning does for you. You can't really walk into a business one day and say, oh, I'm going to sell it, and think that you're going to sell it the next day. You may get lucky. There are opportunities where somebody comes in and says, hey, I want to buy your business. And that's great. Those do exist. It does happen. But even those take 2 to 3 months. Why do we want to start planning in advance? We want to ensure financial stability of both yourself personally as well as your business. You want to reduce the risks in the potential sale. You want to reduce the risks of the business moving forward in a way that helps to secure that particular business. You want to maintain the business knowledge in the operations. You want to protect your business value, and you want to support future growth and build the talent that's in your business and improve smooth transitions. There's lots of different businesses. I'm not sure who is all out there today and listening, but there's so many different industries and so many different sectors of businesses that you really need to take a individualized approach when you're doing succession planning and think about what makes sense for your business and what really drives business value for you. What is important to be in place for your business? So when we talk about succession planning, I guess the first thing we want to consider is, what's your motivation for selling? In some cases, you're close to retirement age. In some cases, you're just tired of operating that particular business. You're not finding the joy in that business anymore. And in unfortunate circumstances, you have a health issue and you need to get out of the business a little bit faster than what you thought. Other objectives really include, do you have family members who are involved in the business that may want to take over someday? Are there employees in your business that you want to, one, either make sure they're secure when you sell your business, or are there employees that may want to actually take over the business, and what's their financial capacity and capabilities of doing so? All of that takes time to kind of plan through and make sure that you are achieving your objectives, for one, and you're getting the best sale for your business going forward. There's always tax and estate planning that you can do when selling your business. I know that my uncle had a small business in Sault Ste. Marie for many years, and he was trying to sell it. He tried to sell his business for probably about 5 years. And when just before, a couple of years before he was going to sell it, I have a husband who's a chartered accountant as well, who does a little bit more tax work than I would do. And he went to see my husband, and they did a little bit of a tax plan. And even though his business was worth less than 300,000-400,000, he still ended up saving taxes of about 200,000 just by going through that process with a tax specialist in looking at the opportunities and options to save money. One of the things we want to cover right now is really looking at understanding that sale process and what needs to happen during that sale process. One is, of course, planning the sale. How is it going to happen? What are we going to do? Two is looking at what the value of that business is, and how do you value your business? How do you maximize that value of the business? What are your opportunities to sell? Are you just going to put a sign up on your door, or are you going to look at different avenues to sell your business? And then how long does it actually take? What can you expect in terms of the sale of the business? When looking at the sale of the business, first you want to think about who are the potential buyers of the business. Again, is it a family member? Is it an employee? Is it a competitor? Is there a strategic buyer out there? You know, if you've grown your business well enough and has a significant amount of sales, is there a strategic buyer who may come in from outside of the city who may potentially want to purchase the business? In doing this, once you identify who those potential buyers are, you'd like to assess the business. Where are we at? What potentially needs to be improved? How do we establish that price? And what are the acceptable structures of sale? You can sell your assets, you can sell the shares if it's in a corporate structure. There's a number of different valuation concepts and methodologies that we use. I'm going to tell you a little bit about that right now. First, as a chartered business evaluator, we have a number of rules and regulations that we need to follow. When we do a valuation, we don't come up with necessarily the price. We come up with what's defined as the fair market value. There's a very specific definition for fair market value. It's really the highest price paid by a hypothetical and willing buyer and seller at a specific point in time. So if you ask me to do the valuation of your business for, say, your year end is December 31st, for December 31st, we're going to value that business as at that particular date. The value could change 6 months down the road, depending on what happens. You may secure an incredible deal with a new customer. That's a 10-year long-term deal. There may be a change in rules and regulations in the industry that you work in that either benefit or don't benefit your business that could change value. So when we do a fair market value, we look at a very specific point in time, and lots of times, you know, things kind of stay the same and value may not change significantly. But again, that's part of the improvements. Once you go through an exercise like that, this is part of the improvements that you get to make, looking at trying to maximize business value, which we'll talk about shortly. The price is really what you're at, the price you're asking for, what's been offered, and what's actually been paid. There may or may not be a relationship to the value that we come up with, and really it's a negotiation between the buyer and the seller. How badly does the seller want to sell? How badly does the buyer want to buy? Is there something in it for them? We've been involved in a number of business values in the region where they have a significant level of sales and strategic buyers come in. I can never really look at our fair market value and compare that to what the strategic buyers are willing to pay, because those strategic buyers are generally public companies, or they're companies in the same business, and they would save a lot of money. They wouldn't have the same overhead you would have. So they're willing to pay a little bit extra to expand their business. So you get a premium for your business based on either one, its location, two, your customers, the fact that you're the only business that provides that service in the sector, in the region. There's a number of different reasons why people would pay a premium for a business. Going into the various approaches to value, we went through kind of the key approaches to value. One is the asset approach, the earnings approach, and the market approach. The asset approach is really taking the value of your assets less your liabilities and coming up with the value of the assets only and liabilities. So if you have, a couple of buildings, you have some vehicles, you have some key assets. It could be a manufacturing firm where you have a significant number of pieces of equipment that would be valued. We would look at the asset approach, and there's two approaches within the asset approach. One is a going concern, assuming that the business is going to continue to operate, or two, the liquidation approach. So it's likely not going to continue in the near future. It's had a number of losses over the years. You're just going to sell the assets. Now, the asset approach, lots of people when they're selling businesses, they talk about goodwill. Asset approach, that doesn't calculate the goodwill for you. That really calculates, again, just the asset value less your liabilities. Now, the earnings approach is what we look at to calculate what potentially goodwill might look like. And there's three key approaches. One is a capitalized cash flow approach. So when I want to buy a business, I want to buy the future cash flows. So if you have, let's say you earn $100,000 per year of net income on your business. So revenues are $1 million, expenses are $900,000, you make $100,000. I'm just making these numbers up, of course. If you make $100,000 a year, I'm going to then assess how likely or how reasonable it is, I think, that you're going to actually continue to make that $100,000 a year. Now, that goes for both the capitalized earnings and the capitalized cash flow approach. However, when we look at the capitalized cash flow approach, we take it one step further and say, okay, so you make on your income statement, you make $100,000 per year. However, how much do you actually have to invest in capital on an annual basis in order to maintain those revenues? So the capitalized cash flow approach is one where the net income and the earnings less the amount of capital that you're going to invest in per year is a lot different. So capitalized cash flow approach is one that we use for capital intensive businesses. They could be a forestry business. It could be a manufacturing company. It could potentially be a restaurant or a gas station. Capitalized earnings approach is same concept, but we don't adjust for those capital expenses, because really those capital expenses are captured in that line called amortization. So we don't have to make those adjustments. And businesses like retail businesses usually use a capitalized earnings approach. Of course, there are exceptions to all of these rules, so we look at each of the businesses individually to determine what approach is best. Now, if you have a business where you think, oh, I'm going to get a sales broker involved, and we're going to hire that broker and valuation firm. In a lot of cases, they'll actually prepare a discounted cash flow. And what that is that's really showing what the cash flows are currently and what they're going to look like in the next 5 years, in the next 10 years. So we use a discounted cash flow. Lots of times the brokers and will want to use a discounted cash flow really to portray the great growth that the business is going to see over the next 10 years or 5 years, whatever it might be. They could use it if it's a new business or a business where you started a new line or you expanded your manufacturing operations more recently, so you can see more significant growth in operations. It could be that your business is changing over the next 3 to 5 years, and it could be a leased property where you have certain properties and you can expect certain leases to end in 3 years, some are going to end in 10 years, and so on. So there's various different reasons why you would use a discounted cash flow, but just the difference between a capitalized approach and a discounted cash flow approach is that one assumes that your past operations is going to continue going forward on a reasonable basis. The discounted cash flow approach assumes that your cash flows are going to continue to change pretty substantially over the next 5 to 10 years. Market approach is a great approach. We actually just talking to a lawyer the other day, we were talking about the approach that another evaluator used, and the other evaluator used the capitalized earnings or capitalized cash flow approach. And he said, but Donna, I don't get it, because when I do deals where we're adjusting for the working capital and we're adjusting for inventory before the sale. So this is where I look at a market approach and say, let's look at multiple ways of doing this. A market approach is really looking at how the industry values the business. And there's various different rules of thumbs. There's different multipliers depending on what business it is. We've done an insurance business many, many years ago, and essentially the revenue multiplier was the approach that people used to value the insurance business. So not only did we use one of the valuation approaches that we just talked about, but we would add the market approach in. It's really looking at it's your ability to look at what comparable market transactions are happening around you. The data in Canada isn't fabulous, but we get a lot of really great data from the US in terms of comparable transactions, and use that to help form some of the conclusions that we have in looking at rules of thumbs. Lots of times, you may hear, well, it's a multiplier. I just have to take my EBITDA or my earnings and I multiply it by 5 times or 7 times, and then I get the value. And yes, that may be true, but the reality is that every business is unique. So for an industry that operates, say, a multiplier of 5 to 7 times, it may or may not apply to your business. And there may be very specific reasons why. And that's why it's helpful to have a professional come in and look at the business from a valuation perspective. So there's lots of impacts on business value, and I'm gonna walk through a number of slides here. But what I'd like to do is caution you when we talk about some of these slides is that some may be more applicable to you than others. And again, it depends on how large your business is. It depends on the sector that your business is operating in. But what this does is the next 2 or 3 slides really help you to look at your business and think about what is driving value in my business, what it makes sense, where can I secure increased value in my business? If somebody's coming in and purchasing my business, what do they want to safeguard my business with? And that could be your relationships. It could be your customers, could be your suppliers, it could be some key employees. If you're a service business and you have a number of professionals that are working for your business, like an engineering firm, it could be, some kind of construction type firm, anything like that. You likely have some pretty critical employees working for you. And those key employees, we want to look at those key employees and say, what's your relationship with them, and what's the likelihood that they could just walk away from this? How long have they been how long have they been at the business, working at the business? How long will they be at the business until they is retirement close to them? When you look at suppliers or customers, what kinds of agreements are in place? Are you a franchise? If you're a franchise and you're a Tim Hortons, you're a Wendy's, you're a McDonald's, you're any kind of franchise, what does your franchise agreement say, and when does that franchise agreement end? Because if that franchise agreement has 1 year left in it, and you have no plan, you have no confirmation that it's going to be renewed, versus if you have a franchise agreement that has 10 years left in it, well, your business there's less risk in the business if it has a 10-year franchise agreement versus if there's only 1 year left in the franchise agreement. The other impact on value is lots of people like to, for those people who are charged taxes on their income, people like to reduce their income to reduce their taxes that they have to pay. So are there a number of discretionary expenses in your business? How much do you pay yourself? How much do you pay your family members? How much automobile expenses go through the business that aren't really business related? Do you have other personal expenses that go through the business that aren't really business related? When we look at your income statement, if you have negligible earnings, I look at it as a business valuator and say, okay, is my future cash flow zero the way it's shown here, or is my future cash flow actually $100,000 or something different, depending on what those discretionary expenses are. We've looked at businesses before, and some of them actually have camps and cottages, personal vehicles, things like that in the actual business itself. So cleaning up some of those things before you start selling the business or trying to sell the business is really good, because it just reduces the complexity of the sale. What are the growth opportunities? When I look at myself, I've been in business for over 20 years now, and started my career almost 30 years ago now. And I'm established. I'm not really looking for growth opportunities, right? But if I was going to try to sell my business, then I'm not doing myself any favors by just being a stagnant business. I'm looking at it and at my business and saying, well, if I want to sell my business, it makes more sense for me to try to continue to show growth in my business, because I'll get a higher value for that business. So I appreciate when you're a business owner, you've been in business for 20 to 30 years. You're making the money you want to make, your business is established, you're doing well. If there's opportunities for growth, and you can start to work on that before you sell the business, there will be a higher impact on value for you. Getting professionally prepared financial statements is really important. If you hand somebody just a set of financial statements that are internally prepared, they're less, not that they are less trustworthy, but the appearance is that they're less trustworthy. Doesn't matter what kind of professional accountant you have doing your financial statements, whether it's a notice to read or a review engagement or audit, people just feel more comfortable knowing that a professional looked at the financial statements first and that they're seeing a professionally prepared set of financial statements. The last is the removal of skeletons in the closet. Take care of your business. And I'm going to kind of walk through a few areas where you might want to look at taking care of your business. And I'm going to touch on these areas. These are just questions for you to ask yourself. Where are the strengths in my business? Where are the weaknesses? What can I do to improve my business before I try to sell it? There's 8 key areas that you want to look at. One is planning, leadership, sales, people, operations, finance, and legal. Going to tell you a little bit of a story, a business in the last 12 months or so. I did a valuation for a business, and the valuation was a calculation. So it wasn't a ton of it wasn't a full valuation estimate or anything. The calculation that we did, though, brought to light a number of different weak areas of the business, and that actual valuation that we did, I have to tell you that it was 50% of it was paid by the potential purchasers and 50% was paid by the owner. So when we were doing it, of course, we're independent, objective. We're trying to come up with the value, but lots of these things in the circle, you have to look at and determine whether or not they apply. And this sale didn't actually go through, and there was a couple of reasons why it didn't. One is, again, just like I had just said, it was a ownership group that they've been happy with the operations of the business the way it is. The business didn't have a ton of debt or anything like that. It was just operating happily. Every day, the owners would go in, they would do the work they would need to do, and that's it. So these potential purchasers come in, and they're super excited about this business. But a couple of things kind of happened. And when you look at this circle, it kind of applies to these areas. First, there wasn't any major plan. It was really unknown what the growth opportunities were and what was going to happen. And part of that was there was no up-to-date business plan. Nobody had done a business plan. It was probably 3 years post-COVID. This business did very well during COVID, but you don't know whether or not that going to do well is going to continue, right? So the potential purchaser was concerned that, well, I don't know what to expect going forward in the future. So we were doing a valuation as of last year, but here's another weakness. There was 6 months of operations that had already happened, and the existing owners couldn't provide them with internal financial statements, up-to-date internal financial statements. They could provide them with something, but nothing that was valid enough, because inventory was such a big factor in this business. Nothing was valid enough that they could look at it and say, oh, here's how you're doing. Even when I came in and did the valuation, the person said, oh, well, yeah, we probably made, $600,000 this year. And when I looked at the statements when they finally arrived, they actually only had made $150,000. So that part of the business was weak in terms of what financial information was ready at any point in time and available at any point in time. There was no budgeting or planning that was done. The last thing that was with this business that was a key point was inventory. There was a significant amount of inventory. And I've had this happen with retail businesses 2 or 3 times over the last 15, 20 years, where the owners are happy with how things are going. They don't have a lot of debt, and inventory continues to creep up and up and up. Well, inventory was probably about 30% higher than what industry standards would be. And while that's okay, it's still an asset, it still exists. It makes it very difficult for a purchaser to come in and purchase that level of inventory, because they're only going to get, from a financing perspective, they may only get 50%. And so they have to come up with that other 50%. So if inventory is, $500,000 too high, that's another $250,000 that people have to come up with, that they really shouldn't have to come up with if the business is being operated correctly. So I'm just going to walk through some of the questions that you want to ask yourself in these key areas, right? Is from a planning perspective, where does your business fit in the marketplace? What's happening with competition? Where's your product? And how does it compare to what other people are selling? Do you see your business staying the same? Do you see it potentially declining if you don't step up and do something? Do you see it in a high growth phase? Leadership, again, walking through key employees. Who are your key employees? And how can you keep them? Do you need to develop your own succession plan as it relates to employees and making sure that you have the expertise needed? And it doesn't necessarily always have to be an engineer or an accountant. Think about your salespeople and how important your salespeople can be in your business. Think about potentially your people who have relationships with your distributors or your customers and how important they are, because they have relationships with those people. What's your corporate culture and how does it potentially have to change? Do you have employees that are leaving every 3 months because they don't like working there? Or is everybody there for a long period of time and it's a happy workplace? What do your sales look like? Can you do anything to secure the customers? Again, going back to those agreements. Do agreements make sense in your business to make sure you can secure your customers? If it's a gas station, as an example, your customer base, you can't do anything about your customer base but continue to service them the way that you are. What can you do to grow your customer base that you have? And what are your key success factors when you're looking at your customers? Why do they come to you on a regular basis? And potentially look at a competitor. What are their key success factors? Why do they go there? And how can you change your business? What are the financial risks in your business? Do you have budgets? Do you have financial statements that are readily available? From a legal perspective, is there any litigation ongoing? You may want to settle that before you want to look at selling your business. Are you operating at capacity? And if you're not operating at capacity, what can you do to operate at capacity? People are so important to every business. Do you have the right policies and procedures in place? Are your employees trained to the capabilities that they need to? And again, looking at that succession plan for the people that you have in place. Going to quickly to some of the business selling strategies. What are some ways to sell? What's the timing? And do you want to use professional advisors? When choosing how to sell your business, you really want to balance the process, your reach to the potential purchasers, the length of time that you need to sell, your cost, maintaining confidentiality within the sale process with your own objectives. So again, go back to the beginning of this presentation. What were your objectives when you're thinking about selling your business, and what makes more sense? Sure, a private sale potentially is cheaper, but is it going to get the job done in the time that you have to sell your business? What about confidentiality? If you post your business on an online marketplace, does it matter to you? Does it matter to your customers? Does it matter to your employees? Lots of people don't want to use online or public manners in which to sell their business, because they're afraid of their reaction from their employees, their suppliers, their customers. So they'll look for a more private way, either using a business broker or selling it privately. One thing, if you sell it privately, it doesn't mean you're on your own per se. Selling it privately could simply mean going to your accountant, your professional advisor, and saying, I'm ready to sell. Do you know anybody who is potentially willing to buy my business? Because your accounting firm likely has, thousands of other clients, and those clients are also at different stages of the business. So often your accountant will make a few phone calls saying, I have this person, and not saying any names, I have this type of business who they're looking to sell. What are you potentially interested? And then they start establishing that confidentiality agreement and working with you more directly and helping you sell your business. What's the timing? Well, the shortest timing could be potentially 3 to 6 months. It could take 2 years. It could take a 2 to 5 year process. It depends on what you want to accomplish. It depends on your objectives. If you're, 55 years old and you have a plan to retire by the time you're 60 years old, now's the time to start thinking about it. What do I need to do to make my exit? Is there tax planning that needs to be done? What is my business value now? And does that meet my financial needs? Do I need to try to look at the next 5 years and grow my business to increase my retirement funds going forward? And that could be a 2 to 5 year process. You looking at growing your business, making those changes. If we go back to that pie chart, looking at legal, looking at planning, looking at your financial, looking at all the risks of businesses. And I think it was on a slide, but I didn't mention it. Only 6% of all businesses really end up completing the sale happily in lots of cases. And why does that happen? That happens because you look at that pie chart, your business isn't fully prepared. So people start reducing the value if it's not, you don't have readily available financial statements. People are concerned. It increases the risk in their mind. If you look at where your employees are at, 3 out of the 10 employees are going to retire in the next year and a half. Well, that's a risk. How is the new owner going to replace those employees? Do you have a plan? If you have a plan, then that increases value. If you don't have a plan, that decreases value in your business. I'm a professional advisor, so I'm a little bit biased in saying this, but I always talk with people, even when I do a business valuation, I always say, always continue to keep your accountant advised, your tax planner advised, because they can save you money in terms of helping you sell your business. They'll help you ensure confidentiality. They've done it before. If your accountant has 20 years experience, they probably have done, dozens of deals, helping their business owners sell businesses previously, right? So they have that experience and they can speak to the risks. They can make sure that you're mitigating those risks of selling your business. The other is that they have time to do this. If you think about how much time it takes you to operate your business right now, try adding another full-time job of trying to sell your business all at the same time of still operating the business and not doing it any harm, right? So it just means that somebody else is going to help you sell your business while you continue to maintain the operations. They're time sensitive, they're goal oriented, they're going to get it done for you. So we talked about a lot of things today, and I talked a lot about many different aspects of selling businesses. And I covered only the very top level of what we really should cover if you wanted to know about any particular sectors, right? So first things first, when you look at succession planning, you look at your business itself. Think about who are the potential buyers. How can you plan in advance now to one, meet your objectives, your financial objectives, your business objectives, your family objectives, what you want to accomplish for your employees. Assess where your business is at and where you might be able to improve it. You may decide, I'm willing to forego money and not make these improvements, and I'll just take a lower value of business, and that's okay too. Take the time though and just think about all of this first, so that you come up with kind of your own plan. You talk with people, you mitigate your risks, and you communicate through the process. Don't ever try to go into a deal and say, well, I'm not going to tell anybody this, that, or the other thing. It's only going to bite you in the foot to do that again. So just keep communicating with everybody. Try to make sure you provide information in a timely basis. If you are in the sales process, make sure that everything's confidential, because you don't want to be providing key information to them without a confidentiality agreement. I gave you a lot of information. I'm happy to take some questions now if we still have time.